Now we will look at an example of the marginal versus average tax rates. So for our personal taxes, suppose we are single and our personal taxable income is $100,000. What is our tax bill? What is the average tax rate? And what is the marginal tax rate? So remember, the average tax rate is our total tax divided by our taxable income. And the marginal rate is what rate we would pay on an additional dollar of income. So we take the table from our textbook on page 31 and we use the rates. So the rates change the more you earn, the higher the rate. Now, that doesn't mean that on our 100,000, we are taxed 24% on that full 100,000. Instead, we are taxed different rates on different amounts. So up to the first $9,525, we pay a 10% tax or 0.10. Then the next range is income from $9,525 to $38,700. On that range of income, we pay a 12% tax rate. The next range of income, we pay a 22% tax rate. And the last range of income, we pay a 24% tax rate. There are additional ranges up to 500,000 and then a flat rate for everything over $500,000. So our total tax on this income would be $18,289.50, at which we paid different rates for different brackets of the income. So our average tax rate is 18.29%, which is our tax rate divided by our taxable income. If we made one more dollar, we would pay 24 cents in tax. So our marginal tax rate is 24%. The tax rate doesn't change again until the threshold of $157,500. So we would stay at that 24% tax rate for any additional dollar of income. Next, we're going to talk about cash flows. So now we're going to talk about cash flows from a finance perspective and not from an accounting perspective. So this can become confusing when we're thinking about the accounting statement of cash flows. This is not the same information that we're looking for. We want to look at cash flow from a finance perspective. So how cash is generated from utilizing our assets and how it is paid to those who finance the purchase of assets. So we're going to have a couple of different types of cash flow that we're looking at. And remember, we don't want to get the finance cash flows confused with accounting cash flows. First, we start with our cash flow from assets. When we're looking at the cash flow from assets, we look at operating cash flow minus our net capital spending minus changes in the net working capital. So our cash flow from assets equal cash flow to creditors plus cash flow to stockholders. So this also follows our assets equal liabilities plus equity. So our cash flows from assets will equal our cash flows for liabilities plus our cash flows for equity. And we're going to look at all of these in more detail. So what is operating cash flow? So operating cash flow is earnings before interest and taxes, or EBIT. And I'm going to move this over so you can see these full amounts. There we go. Now you can see the full slide. Oh, nope, I went to the next slide. So we start with operating cash flows. Operating cash flows equal earnings before interest and taxes. We add back depreciation, which is a non-cash expense, and then we subtract taxes because taxes are a cash expense. Then we look at the NCS, or the capital spending, our net capital spending. So we look at our ending net fixed assets minus our beginning net fixed assets plus depreciation to calculate what we've spent on fixed assets during that time. Whether we purchased assets, sold assets, we can see that on the balance sheet in the change between our net fixed assets. And then we're going to look at the change in net working capital. So remember, net working capital is current assets minus current liabilities. So we want ending net working capital, or 2019's net working capital, minus our beginning net working capital, or 2018's net working capital. So we take current assets from 2019 minus current liabilities from 2019, and then subtract current assets from 2018 minus current assets in 2018, or current liabilities in 2018. That gives us a change in net working capital of $330. So our cash flows from assets are the operating cash flows minus our net capital spending minus our change in net working capital. So we can see then we're going to look at the cash flows from to and from for liabilities and for our equity. So when we're looking at our liabilities cash flows, we have interest paid minus any new borrowing. When we're looking at new borrowing, we're looking at the difference in our long-term debt from one year to the next. We have interest paid of $70, and then we have long-term debt changed from $408 in 2018 to $454 in 2019. So in addition to interest paid, we've also taken on additional long-term debt. So our changes in cash flow to creditors is $24. Then we have our cash flow to stockholders. This is dividends paid minus net new equity. We paid $165 in dividends, and we had a $40 change in equity in our common stock and paid in additional capital for equity. So that equals $149 or $125. If we take the $125 from cash flows from shareholders plus the $24 for cash flows from creditors, that equals $149, which is our cash flows from financial assets. This slide shows all of the equations that we talked about, and of course, we're going to practice these equations in class and in homework. This table can also be found on page 37 in your textbook. The end of chapter 2, we look at the same exact thing from a different company. So instead of that U.S. corporation company, now we're going to look at a company called Dole-Cola Incorporated. So we have information from the income statement here, and the first thing that we want to look at is their operating cash flow. So we start with the earnings before interest and taxes. We add back our non-cash expense of depreciation and then subtract taxes. That gives us our operating cash flow, our OCF. We then look at the changes in our fixed assets and add the depreciation amount. Next, we look at our net capital spending and the change in net working capital. So for our net capital spending, we have ending net fixed assets minus beginning net fixed assets plus depreciation. For our change in net working capital, remember we take beginning net working capital minus ending net working capital to get the change in net working capital. Then for our cash flows from assets, we have our operating cash flow minus net capital spending minus the change in net working capital. In this case, we have a negative cash flow from assets that comes from that financial investment in our net capital spending, where we bought property, plant, or equipment. Our cash flow from creditors is our interest paid minus any net new borrowing. So we took out additional loans in order to finance our asset purchases. We have interest paid of 30 minus our net new borrowing of 225. We get cash flow to creditors of negative $195. We can then use that information to calculate what our cash flow to equity stockholders are, because our negative 195 plus the stockholders must equal the cash flow from assets of negative 165, which means that our cash flow to stockholders is $30. And we can see that if we go back to our income statement, we can see that that $30, our payment of dividends, was the amount that we paid. So that is our cash flows to stockholders. That is the end of chapter 2. And we will, of course, work through more of these examples and examples of calculating tax rates in